Hello everyone and welcome back. Today we'll be talking about measuring the performance of the economy and how GDP is calculated. So first we want to get this idea down of the circular flow, which is pretty much that income, or the flow of income, involves two principles. That in every economic exchange, the seller receives exactly the same amount that the buyer spends. Goods and services flow in one direction and money payments flow in the other. This is kind of like a principle of market clearing. So profits. Why is profit a cost of production? Well, profits are the return entrepreneurs receive for the risk they incur when organizing productive activities. Here's kind of a nice graph talking about the circular flow from households to businesses. So in that previous slide, we had different types of markets. We had product markets, which are transactions in which households buy goods, and factor markets, which are transactions in which businesses buy resources that they turn into production. And there is total income involved here, which is the yearly amount earned by the nation's resources, right? All the factors of production. This includes wages, rent, interest payments, profits received by workers, landowners, capital owners, entrepreneurs. We also want to kind of get this idea of a final good and service nailed down, because it's going to be very important for calculating GDP. A final good and service are goods and services that are at their final stage of production, and they won't be transformed into other goods or services, right? They're ready to be sold, basically. So national income accounting. Now we can talk about how GDP is calculated. National income accounting is just a measurement system used to estimate national income and its components. Gross domestic product, or GDP, is the total market value of all final goods and services produced by factors of production located within a nation's borders. So here's something you may observe, right? GDP measures the dollar value of final output. GDP measures the dollar value, right, of final goods and services produced per year by factors of production located within the nation's borders. I always learned GDP was a measurement of yearly final goods and services, and it's of new final goods and services, and not resold items, and we'll talk about that also in a second. So intermediate goods are goods that are used up entirely in the production of final goods. And value added is this concept of the dollar value of an industry sales minus the value of an intermediate good. For example, raw materials and parts used in production. And now we get this nice little table talking about value added in intermediate goods, which is value added at each stage of donut production. So it starts with fertilizer and seed, and then you have to grow it, and then you mill the seed, and then you presumably make the dough and bake it, and then you sell it. And at each stage, there is value added happening of each intermediate good, and you can kind of read through this on your own and just kind of understand this. So numerous transactions occur that have nothing to do with final goods and services being produced. There are financial transactions, transfer of second-hand goods, and other excluded transactions from national income accounting. So financial transactions are transactions of things like securities, which are stocks and bonds, government transfer payments, which is like Social Security or unemployment compensation, and private transfer payments are individual gifts or corporate gifts. And transfers of second-hand goods don't really count as part of GDP, right? So we don't count, like if you sell an old computer, or maybe you have a snowboard you haven't been using for a while and you sell it. It's not going to count as a part of GDP because it's not a final good. It's reused, right? And there are also other excluded transactions like household production or legal and illegal underground transactions. But so there are some obvious limits to GDP, right? It excludes non-market production, and it's not necessarily a great measure of the well-being of a nation. It's okay at measuring production and productivity, not great at measuring quote-unquote well-being, right? GDP is a measure of the value of production in terms of market prices and an indicator of economic activity. Again, it's not a measure of a nation's overall welfare. So there are two main measures of getting GDP, right? We can do the expenditure approach, which is computing GDP by adding up all the dollars at current market prices of all final goods and services. And then there's the income approach, which is measuring GDP by adding up all components of national income, including wages, interest, rent, and profits, right? So deriving GDP by the expenditure approach is we take consumption expenditures such as like durable consumption goods, non-durable consumption goods, services. Again, these are all final goods and services. And we can take gross private domestic investment, which is just the creation of capital goods such as factories and machines that can yield production and hence consumption in the future. And there is, of course, fixed investment and inventory investment and different gross private domestic investment. There's also government expenditures, which is, any government expenditure at the state, local, federal level that we just take valued at the cost. And of course also net exports, which is the total exports minus total imports. And we get this nice kind of classic GDP formula. And here's a nice graph that shows all the different things that go into GDP. So net depreciation, right? Net domestic product allows for depreciation. It's the amount that businesses would have to save in order to take care of their depreciating or deteriorating machines and other equipment. So it's GDP minus depreciation. So here's some quick math here, calculating net depreciated GDP, right? And so you can kind of see a little bit of breaking down of the formula, right? And then there's a different way we talked about briefly about the income approach, and we can kind of talk a bit more about it now. Gross domestic income is the sum of all income, wages, interest, rent, and profits paid to the four factors of production. Right, this breaks through these a little bit more, but we've seen this in the past, so nothing new here. And deriving GDP by the income approach. Well, so gross domestic product equals gross domestic income plus indirect business taxes and depreciation. And these last items are non-income expense items. Indirect business taxes are all business taxes except the tax on corporate profits. It includes the sales and business property taxes. And here's a nice different sort of graph, or pie chart, excuse me, about the income approach and the expenditure approach. And here's kind of a breakdown of the pie chart. And you'll notice that the gross domestic product and gross domestic income are equivalent. It kind of comes back to that circular flow argument. So the national income is the total of all factor payments to resource owners. Personal income is the amount of income that households actually receive before they pay personal income taxes. Disposable personal income is personal income after personal income taxes have been paid. So it's what's left. And here's a nice chart again, or table again, talking about net domestic product and gross domestic product. You've taken away depreciation, you get your next domestic product, and so on and so forth. And in fact flows all the way down to disposable personal income. So nominal values. We want to distinguish between real and nominal values, and it's an important distinction. Nominal values are measurements in terms of the actual market prices at which goods are sold. They're expressed in current dollars or money values. Real values are measurements after adjustments have been made for changes in the average of prices between years, and there it's expressed in some constant dollars. So what's a constant dollar, right? Constant dollars are dollars expressed in terms of real purchasing power. This is price-corrected GDP, right? This is the real GDP. So here's kind of an example for correcting for GDP for price index changes, right? Because you need to correct it for real values each year, right? A numerical example shows how we can adjust GDP for changes in the price index. In the example shown on the next slide, the GDP deflator used to calculate the values for real GDP from 2000 to 2015, right? And we're using 2009 as our price index. That's what's being used. So you have GDP in nominal values from 2005 to 2015. We have our price index, right? And then we have our real GDP, and there's the formula right there telling you how it's calculated. So here is another sort of formula for per capita real GDP, which is just the amount on average of real GDP per person, right? And here's another graph kind of showing the differences between real and nominal GDP. We also want to think a little bit more about what the foreign exchange rate does for the economy, right? The foreign exchange rate is the price of one currency in terms of another. For example, $1.25 is 1 euro, or $1 equals 0.8 euros. And, I mean, of course, these may not be accurate to the day. These exchange rates are constantly changing, so you can kind of Google to see what the current exchange rates are. And we also have an example of French income per capita from euros to dollars. So it's fine to know that there's this exchange rate, but it doesn't mean anything if we don't know how far your dollar can get you in another country, right? So that's why we want to think about purchasing power parity, which is an adjustment in exchange rate conversions that takes into account differences in the true cost of living across countries. And finally, we'll end on kind of this table that talks about purchasing power parity between countries.